Despite multi-decade high inflation and interest rates rising to levels not seen since the early 2000s, the Canadian economy has largely managed to avoid the worst effects so far. For instance, through the first quarter of this year, real GDP, a measure economists follow to track the growth of economic activity both in Canada and internationally, is up 1.7% annualized. And while the unemployment rate was sitting at 6.2% in May, which is more than a percentage point above its cycle low, that's certainly not an atypical rate for a normal labor market in Canada. However, Canadians' perceptions of the economy, the vibes if you will, don't appear to line up with that better than expected view of the aggregate state of the macroeconomy. Younger households in particular are increasingly frustrated by the challenges they're facing related to the elevated cost of living, and we certainly got a taste of that in some recent by-elections in Canada. Buying a home in Canada is likely one of those factors that is bringing down the vibes in the Canadian economy. A lot of millennials, Gen Z, and even their parents look at the current landscape for first-time buyers and wonder if they or their kids will ever be in a place to own a home. The challenging reality is there don't appear to be any silver bullets on the horizon to bring housing affordability back in line with its historical averages. Hi, I'm Erik Johnson, Vice President and Senior Economist at BMO Capital Markets, and you're listening to another special edition of the BMO Smarter Investing podcast, where we're diving into issues on the minds of our younger audience members. On today's episode, we're looking at the housing market in Canada, certainly a topic that's been very popular of late. My colleagues Sal Gutierrez and Robert Kavcic recently released a report on the pathways to affordability for Canada's housing market, where they explore the state of affordability in today's housing market. And joining me today is Robert Kavcic, Director and Senior Economist, who's going to help sort out what has been happening in the housing market in Canada and bring us to a point where we might be headed in the future here. So anyway, welcome to the pod, Rob.
Great, Erik. Thanks for having me on.
Awesome. And for the sake of our audience, I certainly have a sense of what you do here at BMO Economics, but I was wondering if you might say a little bit more about what areas you cover for us.
So I've been on the economics team for a good 13 years or so, plus or minus. I cover the Canadian economy. I cover various aspects of the Canadian economy, fiscal policy, monetary policy, but I do spend a lot of time covering real estate specifically across Canada. And so obviously that's what we're going to be talking about today, but I cover the resale housing market pretty closely, a lot of what's happening with demographics and supply side issues in the Canadian real estate market as well. So that's kind of where I come at this from.
Well, it seems like we've certainly found the right person in our department to help us walk us through what's been going on in the Canadian housing market then. Now, before we dive into what you and Sal found in your report on the housing market, I was wondering if you could walk us through, how we got to this point in Canada where we've seen the ratio of home prices to median income, rise from maybe roughly around 3 to almost 6% in markets if we exclude kind of Toronto and Vancouver, those really pricey ones. And in those, 2 regional markets in particular, that same ratio is now more than 10 times.
Yeah, so it's a tough environment out there from affordability perspective, and unfortunately, there's not just a simple answer as to how we got here. There's really a number of factors working over a number of different time frames that got us here. So, 3 big things just off the top of my head. One is we just have domestic demographic pressure, right? And this has been coming at us for the last 15 years. We knew it was coming, and it's here right now, and it's peaking right now. And that's the millennial cohort moving into their prime household formation years, and also like moving into their low 30s where they start having kids. They start moving out of smaller units, looking for houses with backyards. So this is demographics domestically in Canada. We knew this was coming all along, and we've been actually very bullish on house prices for single detached housing in Canada for the last 10 years, just simply because of this. And this is a huge force. It is peaking right now, and hence the stress out there from on the demand side. The other factor is when you look at the other aspect of demographics in Canada, it's the international immigration front. Canada has a very robust immigration program, right? We have permanent resident targets that have been gradually lifted to about 400 to 500,000 per year. That's a strong rate of immigration that requires obviously housing to satisfy it. On top of that, we've seen another 800,000 or so non-permanent residents come into the country just within the last year or so. And that's kind of the I don't want to say unregulated or unchecked, but it's kind of the area of the immigration system that is prone to really big numbers because it's not matched by formal annual targets. And that's where the big inflow has come in and really set off our population numbers from something around 1% per year, which was manageable, to now 3 or 3.5% per year, which is really hard to meet on the supply side. So that's adding a lot of affordability pressure as well. And then the other piece of it is it's kind of a cyclical aspect to this. When we went through the pandemic and central banks cut rates to zero and basically promised Canadians that they were going to keep them there. Well, what did that do? It triggered a lot of Canadians to say, well, great, money is cheap. It's going to be cheap. Let's go out and buy and invest in real estate. And you had a lot of investment activity come into the market, a lot of speculative psychology build up in the market that drove house prices well above what income levels would justify. And now that's been cleaned out now that the Bank of Canada has raised rates, but the legacy of that is that it's still left us with a tough affordability problem. So that's where we are, and I know there are a lot of detail behind each of those components, but those would probably be off the top of my head the three big components that have put us to where we are from an affordability perspective. They just all happen to be happening or converging at one time.
Yeah, I mean, I think that's certainly what I'm seeing in the space as well. And one of the things that I found fascinating about your report is exactly that, because we have all these different, longer moving, a little bit more intractable issues kind of under the current of driving what's been happening in the housing market. Even though prices have certainly come down from the peaks we saw in the spring of 2022, what you find in the report with Sal is it seems like affordability over the next several years is only really going to improve marginally from where we find it today. And so I was wondering, can you kind of maybe dive a little bit into the details there of, one, why affordability is so challenged kind of today and why it might not improve that much as we kind of head through the next few years here?
Yeah. So I guess the first thing is, how do we define affordability, right? So when we say affordability, we're talking about somebody coming into the housing market and trying to afford a mortgage payment, basically, right? So the mortgage payment on the average priced house as a share of income levels. So what share of your income are you required to pay to service your mortgage with the standard 10% down? And right now it's never been higher. It was about this high in the late 1980s, early 1990s. We had a housing bubble then, and we had a aggressive tightening cycle and a bit of an inflation problem. So a lot of that echoes today. But yeah, so the problem here is, and to your point, we've seen house prices across a lot of markets come down 20% or so, but they've only come down because the Bank of Canada has raised interest rates. And it was necessary, obviously, to cool a lot of the psychology and get the froth out of the market. But from an affordability perspective, it hasn't really helped anybody because we're just basically paying higher borrowing rates to go out and buy a lower priced house. And those two have effectively offset each other to this point. And I say to this point because as we go further through the cycle, eventually rates will come down, prices are probably stagnate, and over a longer period of time, affordability will find its way back to something that's reasonable. It always does, because a market really can't sustain itself at this kind of level that's out of whack with just underlying incomes and interest rates, right? But so we say it's going to be tough to get there because it's just the arithmetic where there are really three things, I guess, that can happen to make housing affordable again. And one is rates can fall. That's pretty simple. That process is starting, but I think our view on interest rates is that the path for rates lower is going to be pretty gradual from the Bank of Canada. So probably 75 basis points of easing this year. Again, next year, it's a pretty slow path back down to neutral interest rates.
And for neutral, and I guess for neutral there, what would be, your view of where that is kind of relative to before the pandemic?
Yeah. And so that's the other point here, is that you can very quickly restore affordability in housing by resetting mortgage rates back down to 2%, but we're probably not going to do that, right? So neutral for mortgage rates, if we were used to 2% being pretty normal going back over the last 5 or 10 years, you probably have to assume maybe 4% is quote unquote neutral now, plus or minus around that 4% mark. So when you put that in in your mortgage payment calculator, doesn't get you all the way back to affordability, so to speak, right? At least not where it was pre-pandemic. Yeah, and then there are some other ways you can get there. Prices can fall further, which they are in some markets, but in some markets they're not. Or you just need time for incomes to grow and catch up to high prices and still relatively high mortgage rates. And that's the third piece of it. Incomes continue to grow, but that takes time. And we're probably talking a number of years.
Yeah, no, absolutely. I think, to me anyway, I think this is one of the way that creeps into this frustration of the way perhaps like economists like us see the economy sometimes versus, your average kind of household in Canada, particularly your younger households, is when you think of what goes into the CPI basket, obviously people don't really buy homes all the time. And so it's not, the price of a new house isn't really captured in a meaningful way. In the sense of it's going to factor in exactly where house prices are today, all these sorts of things. But then, as you rightly point out, right, if someone wants to be a first-time buyer and is out there in the market, to them, it looks like, even though inflation has come down from its multi-decade highs, it's not like it's made a dramatic difference for what that, overall kind of affordability cost is for buying a new home. And so I think one of the reasons why they're still so frustrated about this is they feel like they're not making any progress despite, some of these things changing.
No, that's totally fair. We don't measure housing very well in the CPI. Like, well, maybe, okay, we probably measure it fine, but it doesn't match the reality that people actually feel on the ground, right? Yeah. And I think that's what you're getting at.
Yeah. And to a degree, there are these difficulties. Like, for one, it is a consumption good, which is, broadly what we're trying to do with a measure like the consumer price index, but it's also can be an investment. And, generally we're not trying to capture what's happening to financial assets when we're thinking about the movement of consumer prices. So yeah, that is always that kind of big challenge there. So I was wondering, we certainly talked at the high level of what's, going on in affordability in this country, where it might be headed over the next several years. I was wondering, is that a picture that looks the same everywhere we go in this country, or are there certain, pockets in different regions that look very different than that kind of average picture you walked us through?
No, this has been very localized, right? So you've had extreme affordability stress in markets like Toronto and Vancouver. And it's not that Toronto's the center of the universe, as everybody calls it, but the reality is that we have a lot of job creation here and a lot of young families competing for very scarce single attached housing in a market like Toronto because of policy restrictions and where we can develop and things like that. Vancouver, it's very similar. It's just slightly different dynamic because we're just geographically constrained in Vancouver, so we don't have a lot of single attached housing. And again, this is something that we've been saying for probably like 10 years, that we're going to have extreme stress for single attached housing because for the last 15 years, by rule, we've almost stopped building single attached housing because of various policy push down to the municipal level, intensification rules and stuff like that. All at the same time that it just happens that millennial cohort is turning 30 years old and they need single attached housing. So that's kind of made the problem worse, especially in those big cities where a lot of these families are employed, right? But from an affordability perspective, like you ask, is this uniform? It's not. And when you push outside the core of these two cities, you find affordability in markets, let's say 1 to 2 hours out. So we're talking areas like Barrie, Guelph, London, Niagara, even provincially, if you push out to areas like Atlantic Canada and Alberta, there's a lot more affordability there. And when you actually, interestingly enough, when you run the same affordability calculation on house prices in Toronto and Vancouver in the early 2000s, when we would have called Canadian housing actually very affordable, and you run that same calculation on markets like Calgary, Halifax, some of the ex-urban markets around Ontario, those numbers are actually very similar. So families are leaving Toronto and Vancouver and migrating into these areas simply for the reason of affordable housing. And like you look at the migration numbers, 50,000 people or so moving into Alberta in the last year, mostly from Ontario and British Columbia. That's just families looking for a single attached house, really.
Yeah, absolutely. I think in a world where, work from home or like hybrid work kind of models are a little bit more persistent, like that's kind of a nice equilibrium that can be a little bit more stable and allows those households to kind of tap into places where, this decision of where to live can be a little bit more detached from the idea that they have to live in this really expensive market where their house is. But I guess the challenge is, we certainly are seeing a little bit of movement maybe back towards, a more typical kind of in-office structure in some of those markets. And so, yeah, how long I guess that persists might affect that at least channel of, spreading out some better affordability across the country for households who are seeking that today.
Yeah, we'll see. And it's funny, I've often argued that a good long-term solution to this has been just infrastructure to get people out of the core of the big cities, right? Because you can't realistically commute from a lot of these markets into a city like Toronto every day. Just like it just doesn't work economically or from a lifestyle perspective. But if you can get people quickly in and out of these areas, then you open up a ton of available housing supply and a ton of single detached housing supply, importantly. And funny enough, the pandemic was a really extreme experiment in this, where we basically shut down Toronto and said, okay, go work wherever you need to work. And what did people do? They moved exactly to these areas because they had affordability. So it's almost, unfortunately, requires like a good 10 years of foresight by policymakers, which we brought it up 10 years ago, but yeah, nothing happened. But there is, that's one probably pretty good way to deal with this affordability issue, is just get people out to where there's actually more space and we can build single attached housing.
Yeah, I mean, and that's certainly not something we have any shortage of in this country. It's just we happen to have a shortage of it in these really big, dense kind of core urban markets that we also don't have very many of. Like, unlike the US, we basically have large cities and nothing else. And so it makes it that much harder to kind of find that balance of, space and affordability across distances in this country. So I guess, maybe we've teased that a little bit, but one thing I wanted to get your perspective on, given these affordability challenges, for younger households, are they sort of in this group today that might be a little bit doomed to maybe be renters or leasers for the foreseeable future? Or is there any potential relief here on the horizon for that group of people?
They're not doomed. For the foreseeable future, maybe it's going to be tough. It's probably still going to be tough, but they're not doomed. Look, there's been periods historically where affordability and valuations get out of whack. And there are a lot of different factors behind them, demographics and various market factors. US housing was very unaffordable in 2006, 2007, because there was a lot of speculative activity. Housing in the US got very affordable very fast when we went through a deep recession. We don't want that here, but it can happen very quickly if you have a negative outcome like that. Similar to that, the late 80s and the real start of the 1990s looked a lot like it did today in Canada, where you had a lot of demographic pressure. Back then it was the baby boom, now it's their kids, but the two demographic curves overlap very well. And we had a lot of the same problems in the late 1980s that we do today, where you had peak demographic demand, you had high interest rates, inflation. Affordability by the mid 1990s got extremely favorable again very quickly. Unfortunately, that also came with a pretty deep recession in a lot of Canada. And again, we don't want that outcome. So our view here would be more of a non-recessionary restoring of affordability in Canadian housing. And unfortunately, it is going to take time for incomes to catch up and for interest rates to gradually settle back down to more neutral levels. So, and this is kind of a long-winded answer, but I don't think they're shut out. I don't think there's, any kind of lack of hope for younger families to buy real estate in Canada, because the cycle does constantly change. And that's kind of the point I'm trying to make here, is that the cycle always does change. And there will be a point again when Canadian housing is actually very affordable. It's just unfortunately not going to be probably this year or next, or maybe even the year after that.
Yeah, and absolutely. I think that's like a nice, thing to bear in mind, that, there have been these episodes of history that don't look that different from where we are today. And certainly they worked out in a place, not always in the way that we would want, as you pointed out, because, certainly the costs on having, a major price correction that comes with a recession would be, pretty tough medicine to bring affordability back to more kind of historical averages. But I think to your point, that we've been through episodes in the past where affordability has kind of bounced back a bit, does offer a little bit of hope for, where things might go for younger kind of potential first time buyers here. So, one comment I've heard a lot recently is this argument that, the only way that we can make kind of housing more affordable in Canada is if we make it a little bit more of a relatively average performing financial asset, as opposed to maybe what we've seen, over the last kind of decade or decade and a half. So I was wondering, where do you kind of stand in that discussion there?
Man, look, I'll be the first to say that we were very early kind of recognizing what was going on in this market, that there was a lot of froth and speculative activity and investment activity building up. And we were pretty quick to say that something needed to be done about it, because once these things get going, they tend to get going pretty far away from underlying fundamentals. And as we can see today, prices have corrected, but they got so out of whack that they still haven't kind of restored themselves relative to those fundamentals. So this is one area I'm pretty hawkish, or I'm pretty careful on. And this is not to say that investment activity is bad, because we need investment activity to bring supply to market, right? We need investment activity to actually, for example, get a big condo project to get financing and then break ground and actually get built, so people have rental supply to come into Canada and live in, right? So investment activity is not bad. But what we don't want to see, and what we have seen over the course of this cycle, has been investment activity kind of morph away from fundamentally driven cash flow investment that is there to kind of meet demographic demand, to just straight out speculation. Like, prices are rising 20 to 30% per year. I'm going to buy 3 units in a upcoming condo project with no intention of closing on it or living in it, stuff like that. That's the stuff that's getting kind of cleaned out of the market right now. And that's unfortunately one type of thing. When you have a really strong market and you have then a policy response where interest rates get cut to zero, and that's like a lot, psychology can change quickly. That's unfortunately something that has a lot of power to really distort the price of housing relative to those fundamentals. So we want to try and avoid that. I don't know. I think where we are today, 475 basis points of rate hikes has more or less eliminated that psychology from the market. And the investor right now, if we look at market conditions, is pretty much gone. It's pretty much absent from the market, because prices don't make sense at these levels relative to rents, and especially don't make sense when they don't have the expectation of price growth to fall back onto as well. So it's pretty quiet out there from an investment perspective now.
Yeah, no, absolutely. And so I know you touched on this a little bit, but one other factor that kind of features into this conversation as well is this idea that we might see, kind of population growth in Canada correct a little bit, depending on, how strict these new kind of federal guidelines on targets for non-permanent residents end up binding. And so I was wondering, in your view, is that something that's going to change, some of the dynamics in the housing market as we, kind of go through the next few years here?
I think it should, if we take the federal policy makers' word on this, and and by that I mean if they're actually going to hit the targets that they're setting out. So as an example, cutting the share of non-permanent residents in Canada to like 5% of the total population. If you do the arithmetic behind that, it's effectively going to require a net outflow of non-permanent residents, and probably a slowdown in overall population growth from about 3.5% today to something around 1% going forward over the next couple of years. So that's a pretty big change, I would say. If they follow through with it, it's going to have an impact. I think it probably doesn't help the 32-year-old family with 2 kids looking for a single detached house in Toronto or a close suburb, but what it will do is take a lot of stress out of the rental market, because a lot of those non-permanent resident flows they're temporary foreign workers and they're international students, and they come in, they rent in Canada right away as soon as they set foot in the country, right? So it'll take some of that demand pressure off. And just coincidentally, as that's happening, you have a record number of condo units under construction right now that's going to come to completion over the next 2 or 3 years as well. So you probably actually do see the rental market balance out relatively quick. And even in the resale market for condo buyers out there is very little competition, and there's a lot of supply, and prices are falling. So it's very different, like depending on what segment of the market you're thinking of this from a rental market perspective, there's probably some easing of rent pressure coming. In the resale condo market, you probably have a very sluggish market for some time still. And I'm talking a couple years, not a couple months. For a single attached house in a core city, still going to be tough.
Yeah. And it seems like that's going to have certainly implications for where we see the rest of the economy. I know like May CPI for Canada, which just came out, showed that, rent again was, certainly well above target at 8.9%, versus a year ago. And certainly, that exactly feeds into this conversation about where affordability is today. And certainly one thing that stood out in, the last time the census data came out, kind of breaking down, the share of rental households versus owner households, spending more of that kind of golden rule of around 30% of their income on shelter. That renter group was, more than double. I think in Canada overall, it was close to 30% or more than 30% of renters were spending more than 30% of their income on shelter. And certainly in the last few years, that's probably only gone further upwards. And so at least on that side, we are maybe potentially seeing a little bit of relief if those population, kind of targets for non-permanent residents do end up binding a little bit. So maybe that is like one avenue where we might see these cost of living pressures ease a little bit when it comes to shelter.
Yeah, that should work. It should definitely help. But again, it really depends what you're looking at here. A 1-bedroom condo to rent is going to be a much different game than a 3-bedroom house for you and your kids still.
Yep, absolutely. And so if there was maybe one segment of the market or one particular, piece of advice you'd give to, a young kind of household looking to enter the housing market, would it be to kind of find if there's, potential space in one of these softer parts of the housing market, whether it's, kind of the condo space or whether it's, seeking out, a market that's had a little bit more of a, kind of step back to fundamentals if they're kind of looking to be a first-time buyer here?
Yeah. So patience would be number one. There's absolutely no rush right now, right? So if you're looking to go out there and as a first-time buyer, speculate on a piece of condo real estate to get your foot on the property ladder, so to speak, don't do that. There's a lot. There's certainly a case for patience here because that market is pretty soft, and we're in a much different environment now where prices are not going to just turn around and take off 20 or 30% in the space of a year, right? So I would be cautious on that front. And if you can actually find a decent place to rent, there's no shame in renting. It keeps a lot of your options open, keeps you mobile. People are moving back and forth across this country right now for a lot of different reasons, employment and affordability. The last thing you want to do is get locked down into a property with negative equity, and then you get kind of stuck there and you can't move somewhere else, right? As a young person that's not attached, you got to be very careful before you make that call. The other side of it is when we start talking about single detached housing, and if you are a younger family and you have started to kind of establish more permanent roots and you know that you're going to be in a particular place for a long period of time, I wouldn't be against sticking your neck out and buying a single detached property right now, even though for the next couple of years where rates are, it's still going to be pretty tough from an affordability perspective. Because when we look 5-10 years down the road, I think there still is a case to be made that single detached housing supply, especially in quality neighborhoods with quality properties, is going to just become scarcer and scarcer as the years go by. So you might have to deal with a little bit of affordability pain in the near term, but you'll probably come out okay relatively soon on that. And I'm not here to give investment advice, but I mean, when you look at this from an affordability perspective or where market dynamics are going, that's kind of what we see.
And I think that's a good point, because certainly one thing, we're seeing today is we're still, pretty bad at expanding the stock of kind of single family housing out there. And so, yeah, if it already makes sense from a life point of view, from a housing consumption point of view for you to go out and do that, then, you're less likely to see, a big movement in the other direction where, all of a sudden you've made a huge kind of financial error, even if, the interim of kind of affording a house today can certainly make that cash flow situation for a household look a little bit more challenging until, rates come down a bit here. So I guess, maybe to wrap things up here, I did want to ask if, we had a magic wand here and we could give you, a little bit of the power to make any, policy change in the housing landscape in Canada today. Is there any kind of policy measure that you would really like to see kind of considered in the next few years to maybe change some of the dynamics we've been seeing on the affordability challenges in the country?
Well, I I tend to lean on the demand side of this equation, right? So look, we've been supportive of all the supply side measures that federal and provincial governments have been pushing out. Things like taking HST off of rental investment, things like that. Anything, and especially this, anything that speeds up the approval process or makes supply more responsive is absolutely something we should be pushing for, because real estate, the problem with real estate, and one of the reasons we get into these boom bust cycles and these really stretched affordability cycles and really negative markets that last a long time is demand can shift overnight, but supply takes years to respond to that changing demand curve, right? You can't build a 100-unit condo tower in 3 months like you used to be able to build a single attached house. So this takes years to bring supply to market. So anything that makes that supply more responsive, makes supply more elastic, so to speak, is definitely good. The problem is policymakers have been really just pushing on supply as the sole answer to this, and you are never going to actually build enough supply to meet the amount of demand we have in this country. We just can't, because the industry is already at full capacity. And look, like I talk to builders all across the country as part of this job as well. If market conditions are positive and there's money for them to make, they're going to build houses and make the money. And they're already doing that as much as they possibly can, right? So when the federal government comes out and says, look, I want you to build 3 times more than you are already, you just can't. Like, it's not a solution, not because it's not a good idea. It's just we just can't do it physically. So then that kind of says, okay, well, then the demand curve is something we can move a lot easier and a lot more quickly. And that's probably where policy would be focused on. And so the first thing we said back in 2021, when this was really all starting to get out of whack, was Bank of Canada needs to come out and raise rates and get rid of this froth in the market. And so they did that. To their credit, they were a little bit behind the curve, but they eventually did it. The other side of this is on the immigration front. I think there's a pretty, and this isn't like a personal view on immigration, but I think there's a pretty widespread consensus now that the rate of inflow into the country needs to be able to be matched on the supply side appropriately. And the level that we're seeing today, especially for non-permanent resident flows, is just not something we can meet on the supply side. So the tap needs to be turned down on that to a more appropriate level. And I think policymakers have figured that out as well. And then the last thing, I mean, longer term, we talked about some of just the infrastructure to get people moving out of the major cities and opening up a lot of affordability elsewhere. And this, unfortunately, is not something we can fix in the next year or two, but from a much longer term perspective, things like that would probably make sense to me as well.
Awesome. Well, thank you so much, Robert, for giving us a picture of what's been going on in the housing market in Canada of late and what we might expect, for younger households and really, for any household in this country over the next few years here. So really appreciate you taking the time to walk us through that today.
Happy to. Thanks a lot, Erik.
Awesome. And thank you so much for listening to the podcast today. We'll catch you next time.